The credit review is a process for examining someone's ability to repay a debt. Most trade credit agreements are considered unsecured debt, which means inventory leaves the supplier without payment up front or obtaining assets as collateral. This poses a high risk for the supplier because it will have nothing to fall back on should the customer default on the agreement. While we can never be certain a customer will repay the debts, there are many steps the credit analyst will take to limit exposure to the bad debt, and that begins with a proper credit review. The process typically begins with the customer completing a credit application. A credit application serves two purposes. It's a data gathering tool and a contract. It specifies the rights and obligations of both the customer and creditor. An effective credit application requires the following information: name and address of the applicant, tax ID number, all contact information, phone numbers, and emails, names of the principals or directors, a bank reference, at least 3 trade references, personal guarantee, if applicable, signed statement of accuracy and permission to verify, documented terms and conditions, an agreement of the payment terms, an agreement of the interest amount on past due balances, an agreement of the applicant to pay all legal and collection costs. Once the credit application is received, the credit analyst can begin the credit review in accordance with the company's credit policy. A credit review begins with pulling a business credit report. The most common business credit bureaus used today are Dun & Bradstreet, Equifax, and Experian. All 3 specialize in providing commercial data, analytics, and insights for businesses. The credit report will include general company information such as the business name, address, telephone number, names of principals or owners, years in business, scoring data. Each credit bureau has its own algorithm for determining a customer's creditworthiness based on historical data and industry trends. The report will often recommend a credit limit based on the data, but ultimately the decision is up to the credit analyst. The report will also include an aging of current active trade balances, as well as public filings such as bankruptcies, judgments, liens, lawsuits, and UCC filings. Customers applying for credit are typically required to provide at least 3 trade references on their credit application. A trade reference is a contact from another supplier with which a customer has a fruitful trade relationship that attests to the customer's creditworthiness. A typical trade reference will include number of years doing business together, highest amount of credit extended, current balance, amount past due, average days it takes to receive payment, date of last sale, and an overall opinion on the customer's creditworthiness. A bank reference is also required on the credit application. A bank reference is information via a form or a letter provided by the customer's bank that is used to determine a customer's ability to meet certain financial commitments. A bank reference will typically include bank account age, number of loans or open credit lines, the average balance, number of insufficient funds transactions, and an overall opinion on whether the customer can meet a specific financial commitment. Financial statements are another tool used by credit analysts to assess a customer's financial health. Publicly traded companies are required to release financial statements. This considered public information can be easily found with a simple internet search. Private companies are not required to release financial statement information. Only under special conditions will they consider sharing that level of financial data with their suppliers. We'll examine financial statements further in the immediate sections of this course. Lastly, the internet. An active social media presence can signify the company is transparent and whether they are meeting their customers' expectations. Google Maps Street View allow you to virtually visit the customer's facility and verify the address listed on the credit application is a valid business address. Google Trends is a free tool provided by Google that analyzes the popularity of certain search queries across various regions and languages. By searching the customer's industry, you can get an idea of the timing of their busy and slow seasons. If the search volume is low, the customer is likely in their slow season. The credit analyst might want to be a little more conservative when when setting a credit line during these times. The use of the internet should be covered in your company's credit policies, so be sure to check with your manager before utilizing this method. We have covered the most common credit investigation tools. Once all the data is gathered and analyzed, the credit analyst should be able to make a well-informed credit decision in line with the company's overall mission. In the next module, we will discuss the company's accounts receivable process.